Welcome to the Bloomberg Intelligence Analyst Call. Today is Tuesday, November 7th at 12 p.m. I'm your host, Christina Fury.
And I'm Chris Cellino. I cover U.S. machinery.
My name is Mustafa. I cover electrical equipment.
Karen Ubelhart, large cap industrials and rental equipment.
So today we're going to talk about the third quarter earnings. They're largely complete, so let's debrief. Let's start with going around the group and just maybe the biggest takeaway you saw in your coverage area, and then we can dig deeper into some topics. Chris, would you like to start?
Sure. So in general, U.S. machinery results were better than we expected, with most companies we cover beating expectations. There were a few top-line misses, but essentially everyone ex CNH today beat on the bottom line. And not only did they beat, but the majority of the companies actually beat and raised their 2023 outlooks. I think roughly 60% of the companies raised, with only about 20% leaving their guidance unchanged for the year. And this really comes on the heels of, really strong 2Q results, with most companies beating and raising there as well. So very solid performance in aggregate. We saw machinery companies beat on the top line by less than 1%, so quite minimal on average, but nearly 13% on the bottom line, which was a slight moderation from the magnitude of the beats that we saw in 2Q. We anticipated strong performance in 3Q, but just not kind of quite at this level of outperformance. And once again, and really not overly surprising, I'd say the share reaction was relatively muted. I think shares were up less than 1% on average post results for the group, as we kind of approach these cyclical peaks in most of the markets. I'd say Oshkosh probably put up some of the strongest results in the quarter, reflecting some improved supply chain performance on higher volume and better pricing, as well as a favorable product mix. And then on the flip side, CNH, pretty weak today. Disappointing numbers as some of the ag markets begin to soften there, particularly in South America and Europe.
Great, Mustafa, what were some of the big takeaways that you've seen?
Sure. So within the electrical equipment and sort of small multis and flow control space, there were some surprises, but most of the earnings came sort of in line. EPS beat of about 7%, which was in line with TQ, but the average price change was actually only 1%. Of course, underlying, there were some big moves, but the main takeaways were that the destocking of distributors that affected the near-term demand impact or near-term sales have continued into this quarter, and the expectation is for that to continue into the fourth quarter. There was some evidence that may have accelerated, particularly for industrial end markets. Dover, for example, which has a lot of exposure to different end markets, the commentary there was destocking was in some pockets actually worse than they anticipated. At the same time, underlying demand has not deteriorated. So come early 2024, distributors should start restocking again. There were some negative surprises from short cycle companies. Rockwell Automation had their backlog and the fiscal year below their guidance, 4.1 billion versus an expectation of 4.5 to 5 billion by management. And also short cycle, the guidance from Cognex, they guide a quarter out, and their revenue guidance was well below estimates there as well. We think that reflects, again, worsening destocking, but also maybe some underlying weakening from consumer end markets. Speaking of consumer, on the flow side, we have Pentair, for example. And again, the pool segment, which is consumer spending exposed, distributor destocking was worse than expected there, but management did guide for the end of destocking in that segment. And then, we can probably unpack further down the line, but the main takeaway from what we saw is that destocking continued, some worsening pockets, especially in short cycle, and then some positive surprises in electrical equipment, especially Eaton, but that was a more of a mixed bag.
Uh, I do the large industrials and the rentals. And the large industrials broadly beat on EPS, some by a little, some by a lot. GE was beat by 46%. That's an outlier. Margins were also really good, but you definitely saw a slowdown in organic growth, and a number of the companies missed on organic growth, beat on margins, and beat on EPS. The raises were very minimal, only one quarter left. Any raises were really just what they did in the fourth quarter, except for GE. I mean, what they the beat for the third quarter. No change to the fourth quarter. So people are being cautious going into 2024. Didn't really get any insights into 2024 from, we got a few general comments from people, but nothing meaningful. And the destocking was a factor. People did mention it. And the rentals, which have one of the better outlooks, it was a little messy quarter because they sold a lot of used equipment, and that does mess up the margins, but the outlook is very good.
Great. And so let's dive into more of the top line challenges. Um, Anyone can jump in here. I guess in Karen's coverage, right, a lot of people missed on sales. What are the key drivers of that?
Well, it was really where you are. If you are in consumer related or are in short cycle, that's where you kind of missed on the top line. Aerospace was, of course, everybody in aerospace beat. But that is really the only standout sector. Even HVAC still, weak because of what's going on in residential, although it looks like that's stabilizing. Parker, they their orders really showed a slowdown, and they're another short cycle company. So it really depends on where you are, and it's no different picture from what we've seen for a couple of quarters now. Consumer slow, aerospace very strong, and a lot of other sectors kind of in the middle. The rental guys still have really good top line. As I said, their margins slipped some because of selling a lot of used equipment. So the story is consumer slow for sure, slowing or down, and industrial holding up, and backlogs didn't really deteriorate very much at all. So the longer cycle stuff still looks good.
Are there
Yeah,
any other drivers for Chris and Mustafa?
yeah, on my side, I mean, it again the top line continues to be driven by pricing, still continues to be quite favorable and really better than we had anticipated, and was really the main driver behind, I think, a lot of the stronger than expected 3Q results. Volumes were minimal to even down for many companies during the period. But those pricing tailwinds will continue to moderate here in the back half of the year as we lap some of those tougher comps, and probably looking at a more normalized yet still probably positive pricing environment into 2024, but certainly not anywhere near what we have seen this year. And somewhat kind of counter to Karen's point, a lot of my guys, we've seen, backlog and orders finally kind of peak and deteriorate here in 3Q. We're still at, near record levels, historically elevated, really above average production visibility into next year. But no doubt we did have orders and backlog both moderate, and I think that was, some of the caution that we're seeing as some of the economic headwinds, along with the contracting backlogs, have certainly created some anxiety as we look into next year.
For my coverage, I mean, it's quite broad, so it was a bit of a mixed bag. But if I were to look at end markets, I would agree with Karen. Aerospace is definitely a standout. Amphenol had more than 30%, 37% organic growth from aerospace sales. And energy is also another bright spot. So pipelines are up double digits compared to the start of the year. Um, On the other hand, we have deteriorating orders for companies like Dover, so that's a mixed signal, I would say. Um, Eaton Electrical America's orders turned negative for the first time in many quarters, but that was against a very tough compare, and the market shrugged that off. The big surprise, I would say, for the top line came from Rockwell and Hubble. And Hubble was definitely a big surprise because that company has been, slowly beating and raising for the past 6 quarters or so. And they cut their 2023 guidance for organic growth by about a point. So they went from 8 to 10% range down to just 8%. And the market read that very negatively simply because all the sentiment is quite positive about grid upgrades and electrification. So any sort of misstep there was severely punished by the market. But then Eaton didn't follow that with a similar sentiment. Their backlog it still grew in Q3. So it could be the exposure of Hubble on the low voltage side. And yeah, we don't see electrification taking a major step down in 2024. It could just be pockets of weakness that Hubble is exposed to perhaps in the near term, especially with the higher rates in renewables. The other thing that happened, and I think that was a mixed signal, is some of the companies turned to M&A for growth. Hubble, they did a big deal, Systems Control 1.1 billion. Dover, FW Murphy acquisition, another big deal for that company. Um, of course, deal timing, it happens when it happens, right? But it seems like companies are more willing to do M&A as organic growth slows down.
Right. Um, so besides sales, right, you all said that margins were much better than expected. Chris, you called out price was a driver of that. Do you see that extending into 2024? Can you give some color on where you think margins are going to go?
Lower. No, pricing won't continue in 2024, not at these levels, right? I mean, we've seen double-digit price increases, pretty much universally across the machinery space. That probably normalizes to kind of low single-digit range next year. I think the cost side of the equation is still kind of somewhat up in the air, with most companies, targeting price cost neutrality. So I would expect a more normal year in terms of pricing. I think 2024 ends up being more of a cost and efficiency type year for most of my guys, just because the volume is not going to be there, and pricing those tailwinds will moderate as we move into the next calendar year. So certainly a more challenging setup, but it still kind of looks to us like a much more modest downturn, and we have certainly you know, several longer term secular growth drivers that should, make this downturn a little bit gentler and probably shorter lived than what we've seen historically.
So what part of the cycle are we in now for your machinery names?
The top, pretty much across the
Okay,
board.
so you're
We think
expecting the down.
trucks probably have the most downside just, from a cycle perspective, but I'd say I think one of the positive themes that we've seen come out of this earnings season, and we were kind of anticipating a more modest downturn on the truck market this year, but some of the initial market outlooks that we got from PACCAR and Volvo seem to suggest even a more modest downturn than even our, I think, pretty conservative expectations. So, we kind of thought Class 8 builds may fall somewhere in the neighborhood of 15% next year. There's industry consultant firms out there that expect 25, 30% declines. I think PACCAR is projecting that market to be down about 8%, Volvo 12%. So I think that's a relatively encouraging sign. We think, freight markets probably inflect at some point next year. There's a lot of pent up demand. We have new emissions regulations coming down the pike in 2027. So we think there's a pre-buy. So that kind of lends support to, a recovery in 2025 and 2026. And then ag, CNH was out today saying they expect 2024 to be down. I don't think that's a surprise, but kind of think that's maybe down more in the mid-single digit type range. And then construction equipment, probably the most resilient of the group, kind of, somewhat muted. But again, probably a little bit more of a favorable outlook there, just given all the federal spending coming through.
And I want to go back to pricing with Karen. The HVAC companies have been getting a lot of price past couple of years too. Has anyone commented on if that can carry through into next year, or where do you see that going?
I mean, it's definitely moderating. Last year they did 3 or 4 price increases and they were up double digit. This year they're more in the mid single. So it is still a pretty good pricing environment, but it's not gonna repeat. Next year I would expect it to be even more moderate. But the HVAC guys generally get kind of mid single digit pricing. So and there is a refrigeration change, so there's some other opportunities to adjust price on the upside. Most of the companies at this point, I would generally across the coverage, pricing is moderating as would be expected. And the one thing Chris mentioned, federal stimulus, which was one of the things I was going to mention, because there are, again, you're going to have to differentiate next year because there's already some of the stimulus showing in like the infrastructure bill, but a lot more is to come, and there's certain sectors that will benefit from more money flow from all those different programs next year. So I think that's a cushion for some, and it's a real lever on the top line for others, like the rental sector.
And for scoring the stimulus money, Eaton does this quarterly now, and they keep putting higher and higher numbers for the mega projects that are in the pipeline. And I think they still said something like 20 or 25%, only around that broke ground. So a lot more is yet to come. Uh,
Yeah.
some of it is
Yeah,
in,
the rental companies quantify that and intermittently, and I know that Ashed's going to do that when they report again. But you're right, a very small amount has broken ground, and they're big numbers already. So, the one thing that may happen is some of it may move, to the right because people are worried about the economy, but a lot of this is gotten significant help from the companies and I mean from the government, and they're also secular kind of investments in a lot of cases. But you might see a little push to the right.
yep, yep. And I guess given the different portfolios we have, we're at different stages when it comes to the exposure to the mega projects. I guess Chris's companies, maybe the rental equipment are at the front end of it. Electrical companies are getting the orders from these projects, or they are beginning to get them. Some of it is in the backlog. And then the CEO of Rockwell made an interesting comment. He said, the automation systems that we provide for the factories, they go towards the latter stages of these projects, right? So they're yet to benefit on the order side from these. So it's a bit of an elongated cycle for some of my companies, some of the automation companies, maybe lighting, which comes towards the end as well.
Back to orders, Mustafa, you mentioned some of the companies you cover, orders were down. Was any of that just the normalizing of supply chains finally, or is that a true sign of weakness?
Um, they're trying to attribute it to distributor destocking, and in some cases, that is true. In automotive aftermarket, for example, which affects companies like ITT, TE Connectivity, Amphenol, um, the services are actually the demand for aftermarket parts is actually pretty strong, but companies are facing destocking from European distributors for 2 or 3 quarters now. So once that inventory rebalance happens at the end of this year, they should see growth. Um, for companies like, I think for some of Dover's businesses, it was just a lot of early ordering or double ordering, and things are normalizing. And the absolute level of orders is actually still above pre-pandemic levels. Um, and the fact that it is slowing, the organic order intake decline is slowing, to me suggests that the bottom is near. Um, and then there were some positive surprises actually in data center, especially AI-driven and demand is driving positive order intake. Vertiv's order intake inflected all of a sudden to positive. They had been declining for 2 or 3 quarters on tough comps. Um, Similarly, not orders, but sales of I believe Amphenol from Q2 to Q3, the decline in their communications end markets, which is mostly data centers, there was a sequential recovery, and they attributed that to AI-driven demand. So there are some pockets of strength actually that are showing up in orders and sales, but the general trend is still mostly for destocking.
Now, how did the market react to all of your companies reporting? Anyone, really get slammed? Has there been an overreaction or maybe the opposite way?
I'd say generally there were some pretty big moves in a number of my names. HRI missed for, again, mix, a lot of used equipment sales, which I've already mentioned. That stock got whacked. GE was up significantly because they beat, largely due to aerospace, by a significant amount. I would say, in general, the moves were fairly dramatic. Emerson missed for the first time in a long time today, and they're down 8%. So it is for my companies, there were bigger moves. 3M did much better than expected. They've had a lot of problems along the way. This is the second quarter that they actually did better than low expectations. That stock popped really big on that day. So I'd say the reactions in my sector tended to be, on the stock perspective, more magnified.
Yeah, and on my side, very muted reaction in aggregate. I think we were up less than 1% on average post earnings, but to Karen's point, there were some large moves within that. And of course, anyone who missed, and in my universe, there was only one being CNH. You got beat up pretty bad. There's a couple companies that missed on core margins that got hit a little bit, but for the most part, even the big beats, relatively muted reaction, just because those fears of the cycle inflecting here and a lower growth environment, and against with declining orders and backlog. So I think it's going to be certainly a more challenging setup next year. So I think that's part of the reason why you're seeing more muted reactions on my side.
Similarly, I guess on aggregate 1%, but underlying, I had some big moves in the portfolio. So Hubble down 5%, which I mentioned before. They cut their sales guidance very slightly for the year. On the opposite end, you had companies like Vertiv or ITT, and I would say the big positive price moves, they were driven mostly by better than expected execution and margins. Um, and then, as I mentioned before, like any slight miss or outlook that was below consensus for 4Q, that was punished by more than a 5% decline or around 5% decline. Um, yeah, it's just that we're very late in the cycle, and execution is, I guess, beginning to matter. Backlogs are quite large, so it depends on how you execute and what the margins are.
So I know we've already kind of commented about 2024, but if we can give a more broader view, what are you guys seeing for next year? Anything that the companies have reported that you weren't expecting? I guess, how does it look going into next year?
I think most of my companies will report growth on the top line, and but everything is certainly going to be a lot slower. The aerospace guys, which would be Honeywell, Parker, and GE, are going to have, maybe they're not growing at 25% in aerospace, but they are going to see double-digit growth. There are some concerns about margins because the original, the OEM business is the build rates are going up, but the margins are still going to be very good in that segment. The rental side, I think it's going to be a better year because after not selling used equipment for 2 years and then playing catch up this year by selling 3 times what they normally sell, they will that whole equipment buying and selling cycle should normalize. More money will be flowing from the stimulus bills and the large rentals, the 3 large public companies. Their market share is 2 to 3 times what their real market share is, or in these big projects. Obviously, not URI. They have 17% market share. They're not going to get 65%, but they get a much larger share of the large projects because there's very few companies that can handle the big projects. So I think it's going to be good on that end. I think on the HVAC side, I think that resi is going to start to level off because it's been weak for over a year now, and commercial HVAC is going to slow, but I still think it's going to be positive. Again, because most of the non-res markets are going to show some growth next year, except for obviously office and retail and things like that. And there will be a lot of industrial spending, which will help them as well. And then everything else is, those are kind of the big end markets. And energy, we'll have to see. Prices are still in a pretty good place, oil prices, but the capital spending levels are not expected to grow too much. So. And then it'll be, who executes well on slower growth, and we know who they are, and those are the ones that'll probably outperform.
Any views on Parker, Karen?
Yeah, Parker's orders were down. They're short their industrial business, which is now about 75% of the company. Orders were down. The volumes were still up, but they did moderate their organic growth outlook a little bit. But they've got aerospace is bigger than it's ever been for them. So that's giving them, that will temper the cycle for them for sure. And they execute amazingly well. So even though you did see slower growth rates, their margins were through the roof and the stock was up 9% when they reported. So I think that they'll give us good execution, but there will be slower top line. And versus prior cycles, they're going to do better because of aerospace.
Yeah, I mean, on my side, if I could quickly add, I agree with the end market commentary, and Rockwell did come out with their guidance for next year because they're a September year end, and the organic growth outlook was -2 to +4%, I believe, for revenue. And that -2, they gave some context in the earnings call. What would it take for the organic revenue to decline? And the comments from management were that, not only some of the projects would be deferred, but a lot of them would be canceled for revenue to decline. So that's the setup going forward. The macro is, I guess, tenuous, but the backlogs are high. So there's organic growth coming from that. And for a lot of the smaller companies I cover, companies like Flowserve, for example, the catch up to the supply chain happened later compared to the large companies. So the backlog margins are actually better than what they're selling right now, right? The pricing that is in the backlog is actually better than what they're shipping in Q3. So earnings growth should remain positive. In some cases, double-digit EPS growth for next year, but definitely sales growth slowing. Price cost contribution, which was pretty material up until now, that is going to be either low single digits for a lot of my companies or maybe neutral. For a company that always had some pricing power like Amatec, they used to do more than over 100 bips during the supply chain crisis. That's going to moderate to maybe slightly positive now. So I would argue with the end market comments, and just the detail is that, slowing growth potentially to low single digit, mid single digit organic for most of the electricals. For very good executors with very large backlogs like Eaton, high single digit organic sales growth, and in a lot of instances, I think still double digit EPS growth. If we have a recession, all bets are off.
Yeah, and for my guys again, it's a much more muted outlook, looking for very little bottom line growth next year. Probably more risk to the downside as well. And again, it's going to be a cost and an execution story with most of these volumes starting to inflect and move lower next year.
Is there any noise that investors should be ignoring?
I think the interesting thing is the whole debate around supply chain normalization and is demand actually deteriorating when we look at a lot of these backlog and order trends that at least we saw kind of unfold here in 3Q. Pretty much universally, we had backlogs and orders come down, some at a double-digit clip. Most companies like to attribute that to the normalizing supply base, and I'm sure that is playing itself out. But I am curious to see. I'm sure there is a demand aspect to that as well. And I think CNH was an indication of that today, just given some of their end market comments, particularly in South America and Europe, where they actually did see the demand start to deteriorate, largely because of soft commodity prices and the double-digit declines that we've seen there. So I think that's kind of going to be an ongoing debate here into next quarter, is really what's true supply chain normalization and what is in fact the demand outlook as we move forward.
And maybe China is a noise that investors should pay attention to because that was incrementally worse in the quarter, came in below expectations. I know for a lot of the companies that Karen and Chris cover, the exposure is not that high. I have some which have more than 20% exposure, like Amphenol, for example. Not that that particular company did badly in China, but it seems like Rockwell, for example, cited this. Orders are getting delayed in China, and there is some risk of cancellation. The recovery post-pandemic never really took off, so if that spreads, that could be a risk for 2024.
I'm curious to see how the aerospace supply chain performs in 2024 because that's a sector where it's still really bad, and it tends to be at the tier 2 and 3 level suppliers. Um, and the bigger guys, like GE said, they're getting their own internal efficiencies, which are helping, but they're still seeing a lot of particularly labor shortages in the aerospace side. But if that gives a little bit, that could even be a better market because they can't produce for the current demand. So, the backlogs just keep building. So that's something that I'm watching. There's no signs that labor's easing, but it might sometime next year.
Great. Well, thank you so much for all of your insights. A lot to think about after this last quarter. Have a great day, and we'll see you next time.